The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. I'm Steve Sedgwick in London, and we've got Annetta at the ECB in Frankfurt and Caroline at the Swiss National Bank in Bern. And these are your headlines. The Nasdaq closes above 20,000 for the first time ever, after November's CPI print comes in pretty much in line with expectations, paving the way for another Fed cut next week. The risk-on sentiment extending to Asia, where investors are watching for signs of further stimulus out of Beijing's two-day economic summit, wrapping up today.
The ECB is all but certain to cut rates for a fourth time today, but attention will be on the outlook for 2025 as the bloc grapples with stalling growth in Germany and France and the impact of Trump 2.0.
And we are counting down to the first SNB rate decision under Martin Schlegel, with a cut widely expected, but the market split on the size.
So look, as is the wont of journalists and columnists and analysts and strategists and everyone who's here to comment on the markets, you try and tie a move with a rationale. That's kind of what you do. You fill in the gaps as well. And this extraordinary move from 10,000 to 20,000 on the Nasdaq has been, quite frankly, the biggest momentum trade of all time. How has it happened? I'll come to that in a few moments' time. But the fact of the matter is, when we're putting in the headlines as well, and I put in the headline, yes, as the market expects a further rate cut from the Federal Reserve as well. But is that really what's driving some of these stocks? And I'll talk you through some of them because it's quite extraordinary. It's risen from 10 to 20,000 in 1,645 days. Remember that, 1,645 days, 1,645 days. Look at that on the screen on the left. That's how long it took to get from 5 to 10,000, 7,398 days. So the speed of which it has doubled in value, and don't forget, doubling from 10 to 20,000 is worth a lot more than doubling from 5 to 10,000, is quite extraordinary. The run comes despite, of course, the 33% slide we saw in 2022 as inflation pushed the Fed to deliver a series of rate hikes. But is it about rate hikes, or is it about the recent AI optimism fueling the index to record highs? Let's take a look at some of the individual stocks, and you'll see what I mean about whether this is purely about rates or something else as well. So I'll go through this. Information technology stocks since 2010, since the middle of the year 2010, have put on 38%. We've seen financials put on 31%, consumer communication services 45%, consumer discretionary up 35%. But it's in the individual stocks, and that's what you're looking at on the screen, where these, quite frankly, historic and extraordinary moves have happened. Nvidia, I know you're used to big numbers with Nvidia. Let me just tell you, it has put on, since the 10th of June 2020, wait for it, 1,380%. 1,380%. It closed on the 10th of June 2020 at $9.37. Do you want some more of the stats? I'm going to give you some more if you want them or not. Supermicro has put on 1,186% since that date as well. Why Supermicro? Supermicro has become pretty much a word, a mot du jour for crypto, hasn't it? Of course, and what the leadership there has decided is their big bet going forward. Tesla, despite the fact that they're being whooped by BYD in China at the moment, has put on 504%. Broadcom, 473%. Palo Alto Networks, 412%. I could go on. Should I go on? I'll do one or two more for you. So let me just pick out one or two more names. KLA Corporation, 237%. I've got a couple of big ones you've heard of here. Meta, 168%. And Alphabet, both classes, both the ones you get to vote on and ones you get to vote on less, 160% higher as well. I'll do Netflix for you, final one there, 116% higher over that period. So, you've seen big tech. We have a look at treasuries. What's going on the other side of the coin? These are firming up. We were down to 4.1 a couple of days ago. Look at the 10-year now, 4.283. Because quite frankly, the data is solid. I mean, we talk about CPI performing so beautifully that the Federal Reserve can cut rates. Did no one else see that the core held steady at 3.3%? The target is 2 for the headline figure. Just saying. Dollar crosses. And here's a very interesting story. The dollar continues to rally broadly, although the pound's having not a bad run at the moment, 127.64, back to its recent highs. The euro, someone find me a good reason to own the euro. I might ask Elliot Hentov about that in a few moments' time. But the euro remains under a lot of pressure. The dollar remains ascendant against the yen as well. And the dollar Swissy, ahead of Carolyn talking to us a little bit later on about that S&B rate cut, because we think it will be, is just giving, well, it's flat, isn't it? 0.05% lower. Okay, Asian indices. We said in the headlines that they were getting a bit of a boost from the positive sentiment. Hang Seng up 1.6%. Positive sentiment from lower US rates, or hopefully more stimulus out of China. Drip, drip, drip. We keep getting it, don't we? The Nikkei is up 1.7%. As the dollar remains pretty strong on that dollar-yen pair. These are the opening calls for Europe, and quite frankly, it is the dampest of damp squibs in Europe at the moment. Week to date, the FTSE's flat, DAX is flat, CAC is flat. And that's despite the fact, of course, that we are expecting more rate stimulus this week out of the ECB, and who knows, out of the Bank of England on the 19th of December. So, back to the CPI. US CPI rose 0.3% on the month in November. That figure was in line with expectations, marking the fastest rise in monthly inflation in 7 months. Let me just remind you, we're seeing cutting rate, 99.9% of it, or give or take. I think we're going to get a rate cut on the 18th, but you've got inflation rising. Doesn't matter, does it? Not touching the sides. The headline annual inflation rate was 2.7%. Did not derail those bets, did it? What are we now? I said 99.9. I was joking. But it's still 96.6. Can we get the 96.6 even smaller for our viewers out there? You do realise the average age of a viewer is probably about 56, which is older than me, just about. Anyway, not derailing those bets. Thanks, David. Look, I'm going to really look in close now. 3.4% going for a hold. Wow, there you go. That's according to LSEG data. Right, back to letters I can read. PPI data is due today, with the annual figure expected to tick. That's it. That's the kind of graphics I need. That's the top line of the chart in the opticians, isn't it? Whew. Right, expected to tick up to 2.6% with 0.2% growth expected on the month. According to analysts by Reuters, polled by Reuters even. 2025 will finally be the year of the soft landing that it materialised, according to State Street Global Advisors, which says rates will continue to ease amid economic resilience. Delighted to see Elliot Hentov here, head of macro policy research at State Street Global Advisors. Your eyes are better than mine, yeah?
No,
do you have
just about. I do have contacts.
Oh, you're cheating then. No, that doesn't count. How are you?
I'm great. Markets are great. The economy is doing fine. You just pointed out all your screens are green.
What's there not to like? What on earth do I find to worry about for 15 hours a week on this show? What are you worried about?
I think I'm worried about the consensus worry, which is that, as you just pointed out, inflation starts to shift up faster than we expect. I think I'm in the 96-point-something% that you just referred to. Yeah. We obviously do expect...
Because 3.3% and higher headline figure on inflation, that's okay. We don't mind that anymore.
It's okay.
I thought it was all about the trajectory to 2%, not up to 3%.
You have some two-way inflation risk. I think clearly the upside is starting to rear its head and dominate, but you still have some downside risks, particularly with the labor market. Look where jobs have actually been created and hired in the last few months. It's been particularly in government. Now,
for most of your career, you tell me that 4.2% is pretty close to full employment, I reckon.
It is full employment.
So tell me about the risks and downside then.
If you take government hiring out, and we did have an election in the US, and so one has to assume that there'll be some change in government employment trajectory going forward. If you take government out, actually the labor market has been softening quite a bit, and you'd probably move away from that full employment picture. But by and large, I think I'm with the main risk, which is inflation could come back faster and more viciously, and therefore we don't get all the rate cuts we're expecting. So that is the risk.
How much is Doge going to cut then, if that's what you're talking about, the government employees being cut? They reckon they're going to cut, $2 trillion a year? Carl Weinberg, great friend of mine, just like you, nice bloke. he says 2 trillion a year is ridiculous. He says out of the total 6.9 trillion in spending, 4.4 trillion of that is from health services, Medicare, Social Security and veterans benefit. No Congress is going to let those slip as well. Defence is 900 billion, and that leaves 1.5 trillion for all the department government spending, including for the White House as well. Is he really going to cut 2 trillion out of 1.5 trillion? I mean, I'm not the best at maths, but I don't think you can cut 2 trillion out of 1.5 trillion.
I used to be a sovereign analyst for S&P.
Yeah? How'd that go?
Well, I was there when the US got downgraded in 2011. There is, even the best budget cuts will be, from a macro perspective, will be a drop in the bucket. I mean, I do expect they'll find triple-digit billions of savings, 100, maybe 200 billion. But that's, at the end of the day, when deficits are well north of $1 trillion, it's not meaningful. Okay. It could only maybe be meaningful in how government operates, but even there you have to be very optimistic.
I've just thought of something, you know, and again, I'm not a former sovereign analyst like you, but tax cuts plus tariffs, they're not going to create deflation or a disinflation, are they?
Well, tariff is a tax increase, and then you do have tax cuts. Theoretically, if you're a magician, you could optimize it so that one offsets the other.
It's a tax increase for consumers.
It's a tax. It's also a revenue raiser for government. It is a tax.
Is it going to raise a lot of money?
A lot is in the eye of the beholder and how you structure them. It's very hard to get that right because tariffs are not, the tax year starts, the rate, and you can make very firm projections. No, tariffs go through kind of phasing, consumption patterns change, production shifts. So you can't really plan the same way. Plus, the amounts are not big enough to pay for the tax cuts.
Hey, I just thought we're being so negative, Nelly. Let's get positive. Why do we still own the stock market?
Well, it's delivered, has it not? What were the numbers you were just showing? It's been fantastic.
They were quite big, weren't they?
What is there to complain as an investor?
Can we put up the chart that shows how many days it took? That was a big one. I understood the letters on that one, or the numbers even. But to get from 5 to 10,000 is X amount of money. To get from 10 to 20,000 is double that amount of money. There you go. That's how smart I am if it's value adjusted. But the speed with which it's done it, is it anything to do with anything other than tech euphoria and momentum?
That's broadly right. I think the question really is, could this be an illusion? Is all the capex that's flowing into tech eventually going to dry out because it doesn't deliver? I think you have to be a very brave man to say the AI innovation is not some structural shift and change in the economy. And in the end, a lot of capex is wasted. It's hard.
So you've made two very important statements there. It's absolutely going to change the economy, in my humble opinion. I know very little, but I mean, you look at the technology, you look at the productivity, it could be phenomenal. But equally so, yes, there's going to be huge changes, but is it going to come through into margins and profitability of these companies? Because as you quite rightly say as well, there's also a lot of money that's going to be wasted.
Even if it was wasted, the big winner, NVIDIA, even if theoretically it's all wasted, everybody's buying these chips and processing units, and eventually doesn't deploy them well. Well, NVIDIA still makes money off of having delivered them.
And the case for exceptionalism on NVIDIA has been very well documented, and I totally understand that. It's got its moat, its valuation isn't even as high on a forward PE multiple as the mean multiple of the Nasdaq composite in the start of 2000. It's still at a 30 handle, where that was at a 40 handle as well. So it doesn't look unbelievably expensive. NVIDIA I get, the rest I'm not so sure about.
Again, there's clearly going to be what's perhaps a little bit different is the volume of capex required. This is not people starting up businesses in garages. This is obviously incumbents attracting huge pools of capital, deploying mass amounts of capex. Probably some of them are going to be outcompeted within their group. But it's hard to say that the market as such is throwing away money into something that's not going to deliver higher returns.
Good. So it's a good news story. Good news for the stock market. Good news for the economy.
It's good news for the economy, yes, because it should lift productivity. We're seeing that happen now. We're seeing it's showing up in terms of productivity is looking better in the 2020s than it was in the 2010s.
Okay, so let me go back to my introduction to you as well. 2025 will be the year a soft landing materializes. Not everything you've just said to me about NVIDIA, about the productivity, about how it'd be better for the economy as well, doesn't say to me we're going to get a soft landing.
You're thinking it sounds more like a no landing? Is that?
I think it sounds totally like a no landing.
Well, the softer landing, and I said that's the upside inflation risk, is that we won't get all the rate cuts we expect. We actually get the Fed pulling flat earlier. To what degree that's a problem for the market? I think you can see in the bond prices right now. You already have a lot of that being priced in. The equities don't seem to mind. Okay. So you have growth that's still healthy and robust with probably a 2-handle even.
Hey, can we put the euro dollar up? I did say, show me someone who's got a good reason to buy the euro at the moment as well. And I said I was going to ask you, so I better ask you. Are you that person, Elliot, that can show me a good reason to own the euro or to close the gap on European equity valuations compared with the US in 2025? Is there a very good reason for our viewers to get well excited?
I can paint you that fantasy scenario. We know what needs to happen. It's just the odds are very low.
You can paint me that fantasy scenario.
I don't know if we want to do that after the break. I'll paint you that scenario.
Yeah, let's do it in the break. How about that? Lovely. Have we got you after the break? We haven't got Elliot after the break. No, we haven't. No, they want to get rid of you. Despite the fact you were beautifully here at 5:30 a.m. and disturbing your wonderful sleep. I love chatting to you. I've always enjoyed our conversation in 2024. I want lots more in 2025, as do our viewers. So, Elliot, thank you so much indeed for your time today. Elliot Hentoff is Head of Macro Policy Research at State Street Global Advisors. Meta has donated... Interesting. Hang on. Didn't we do this? I've got to do this quickly because I'll do it slowly because I've got to think. I've got to go in my head. TikTok was going to be banned. Yeah? Is potentially going to be banned. The one lifeline could be Trump, yeah? But one of the reasons why he doesn't want to ban it is because he doesn't like Zuckerberg. Isn't that the point? Because he's worried about the dominance of Meta. I am right, aren't I? Did I get that right? Yep. Elliot's nodding. I can see you all nodding. Okay, let me go with this thing because I'm a bit thick. Meta has donated, who do you think it says it on the screen, what a shame, has donated $1 million to the President-elect Trump's inauguration fund. Ooh, that's interesting. The latest step from the company and CEO Mark Zuckerberg to boost ties with the incoming president. Oh, how lovely. Zuckerberg has met with Trump. Wow, he's met in Mar-a-Lago, the Southern White House, since the election, whilst top executive Nick Clegg, wasn't he the Deputy Prime Minister? He was, of course he was, Deputy Prime Minister in the UK at one point before he became a top software guru. Nick Clegg has responded to criticism over moderation policy, saying errors have led to, quote, harmless content being penalised. There's a lot of harmless content out there, isn't there? President Trump has reportedly invited his Chinese counterpart Xi Jinping to his inauguration next month. This according to CBS, which says the offer was made soon after the election. It's not clear whether Xi has accepted what is an unprecedented invitation, with no record of a foreign leader ever attending an inauguration ceremony. Isn't that extraordinary? Which ally do you want? I'll pick Xi. And this is Xi, who, of course, potentially is the man who the US is going to go up against on trade policy. How exciting this is. All kinds of friends and enemies getting themselves in. What's the old phrase? Elliot's still here. He can't get out. He can't get out. He's desperate to get out and do some work today. Was it keep your friends close and your enemies closer? I'm pretty sure they say that. China's yuan is feeling some pressure today as markets continue to digest the Reuters report that Beijing may allow their currency to weaken next year in a bid to soften the impact of tariffs. The PBOC set today's midpoint at we've got a great decimal here, 7.1854. We need that decimal. Anyway, Elliot, you might get out during this report if you're quick. Sam, followed this report.
China's currency in focus after reports authorities are considering allowing it to weaken next year to mitigate the impact of Trump's tariffs. The market is expecting the yuan to be used as a shock absorber to offset the trade shocks, but many are wondering by just how much. Sources telling Reuters it could drop to 7.5 per dollar, which is about 3.5% or so more than the current levels, but less than the more than 10% we saw under Trump 1.0 duties. There's also been talk of switching the yuan's anchoring from the US dollar to a basket of other currencies. Now, letting the Chinese currency weaken would make those exports cheaper, which would be helpful given outbound shipments are about the only leg that China has left to stand on for now while domestic demand catches up. Markets are also awaiting a readout from a key policy meeting happening over in Beijing, which will hopefully give more detail about the direction of stimulus next year, although any quantified stimulus won't be unveiled until the annual meeting of Parliament in March. Many believe the Chinese leadership will wait and see what Trump's policies actually look like before coming up with the size of the stimulus. Trump has reportedly invited President Xi Jinping to his inauguration. It's not clear if the Chinese leader has accepted, although it would be fairly unusual for him to attend. There is talk, though, he may send a senior delegation instead. In Singapore, Sam Vardas, CNBC Business News.
There's so much in there. I can't even keep up with this news flow sometimes. So you've got China, which is potentially going to have a trade war with the United States, or the US is going to have a trade war with the Chinese potentially. The Chinese just kind of letting the Americans know they have a few tools in their armory as well by, potentially getting this yuan lower as well, boosting the terms of trade for its exporters as well. And then at the same time, Trump's first major international peer that he's potentially going to invite to inauguration, which is so unprecedented in US history, is the Chinese. I mean, you can't work these up. This is going to be so tricky for all of you trying to work out how to trade Trump and how to trade the Trump tariff trade over the next few years. It's extraordinary. I just actually wanted to know what the latest stage was, by the way, and this will probably trigger the same thought with a lot of you as well, is where's China on the manipulation story as well in terms of how the US Treasury sees it? And the latest report I've got for you is from November 14th, which says no major US trading partner manipulated its currency in the year to 30th of June, the Treasury Department said on Thursday. This is Reuters copy as of June. The Biden administration's first semi-annual currency report before turning over policing, of course, to the foreign exchange practices to the next administration as well. So very, very interesting. Trump, who of course has complained about the strong dollar eroding US trade competitiveness. You've got the Chinese who are making the yuan weaker, and how this plays out with the inauguration. I find it mind-blowingly confusing, and actually from a news point of view, let's be honest about it, quite exciting. Coming up on the show, it's a big day on the monetary policy front. We're going to be live on the ground in Frankfurt, where traders are pricing in yet another cut from the ECB. Plus, the FBI director, Christopher Wray, I don't think this one's a huge surprise, is it? He's announced plans to resign. We'll bring you the details next. And we're going to speak to the CEO of Schott Pharma. Amazing company. They do drug vaccines and delivery and vials and syringes. But anyway, they reported a solid end to the year with a record margin. That's a first on CNBC interview with Andreas Reiser later this hour. We are counting down to the SNB's rate decision today. I'm doing it here in the warm. Carolyn's doing it in the cold. Markets expect a cut with a near 60% chance of a 50 basis point move lower, according to LSEG data. Carolyn, this is absolutely fascinating. The Swiss have got a great economy in so many ways. What are they concerned about? In addition, they must be concerned about one thing that the Europeans don't have to worry about, which is a rallying currency, which, of course, has been such a huge part of the safety trade over the last 20-odd years.
Absolutely. You hit the nail on the head. What the Swiss are concerned about, and rightly so, is the strength of the Swissy. And as you and I both know, this is not a new problem. This has persisted for the last 15 years, since the financial crisis, the Eurozone debt crisis, now the latest geopolitical problems, and everyone is flocking into the Swissy. It's close to record highs against the Euros. And I talked to so many companies here on the ground, and they're really dealing with the fallout from the strong Swissy. On top of that, the very weak demand coming from one of its biggest trading partners, Germany, and overall the Eurozone, of course. So this is what the S&B is concerned about as well. On top of that, obviously, as inflation drops, and the latest print that we saw in the month of November, 0.7%, a 3-year low, the specter of deflation. So as expected, we're going to be seeing another cut today, whether it's 25 basis points or a jumbo cut. It remains to be seen. But as we discussed before, that is very, very close. And that's where it gets very juicy. It's very close to negative interest rates. And obviously, so much speculation in the markets as to whether we are going to return to those negative interest rates. Now, obviously, today is the first time that Martin Schlegel will be presenting the news on monetary policy to the media, to investors out there. Obviously, he's no stranger here. He's been the vice chairman of the S&B for a couple years. He was alternate member to the governing board since 2018. But he made some really interesting comments at the University of Zurich last month, and that actually led to a bit of a sell-off in the Swissy. He said, nobody loves negative interest rates. The S&B does not love negative interest rates, but if it is necessary, we are ready to take the next step. So, option markets, they're increasingly pricing in negative markets by December 25th, 2025. That's only a year from now. And obviously, there's been a lot of discussion amongst analysts, amongst economists about the merits of negative interest rates. And we all know, well, it's been pretty mixed, right? The S&B, they've done that for 7.5 years. They've only exited negative interest rates 2 years ago. But interesting note out from Morgan Stanley roughly a month ago, they say, while the merits of negative interest rates are open to debate, the re-implementation far from a foregone conclusion, we think the risks from market pricing negative interest rates are tilted to the downside. One more thing I'm going to add here, Steve, is that even if we don't get negative rates, what the markets will be pricing in either way is continued FX intervention from the S&B, which is a tool that they've relied on so heavily over the last couple of years. And of course, you and I both know this is the main reason for its bloated balance sheet. So a lot to think about for the new chairman. Of course, we will be talking to him in a few hours' time.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.